I want to welcome you guys to the Dubai International Financial Center this morning. And we're going to be talking about the new Silk Road, which has been a major topic of conversation ever since President Xi Jinping announced it in 2013, or announced the Belt and Road Initiative, the BRI, a major investment in infrastructure across corridors that would spur tremendous growth across various industries. And why wouldn't it? I just Googled it actually yesterday when I was told to do this introduction, and it talks about 30% of the world's GDP, I mean the countries being involved, 62% of the world's population, and 75% of the world's known energy reserves. Major. In fact, His Highness Sheikh Mohammed bin Rashid Al Maktoum, the UAE Vice President and Prime Minister and ruler of Dubai, when he visited China in April, talked about his confidence in how this project, this initiative, would do what it did in the original Silk Road, which is to connect communities and economies. The UAE is in a great position. I mean, first of all, we are on the corridor, which is fantastic. We've got a major Chinese population that calls UAE home, over 200,000. The bilateral trade is about to grow to $100 billion in the next 3 years. We've got the 4 largest Chinese banks based here at the DIFC, and we have many, many conversations every single day to continue to drive this. The DIFC now being one of the top 10 leading financial centers, and I love saying that after that was announced on Thursday, wants to continue to do what it does best, which is to enable companies to tap into the opportunities of the BRI. In essence, we want this to be the HQ away from home. And we think we have great legal and regulatory frameworks, we have great structures, and we have great trade finance products right here at the DIFC to support anybody that's interested in tapping in to the opportunities. I've already talked for a very long time, so I want to welcome Gregory from our partners, Arbuthnot Latham, to present the report, some results, and also possibly some more opportunities for people to be involved. Gregory.
Very warm welcome to all of you to the DIFC. My name is Gregory Perdon, and I serve as Co-Chief Investment Officer at Arbuthnot in London. I'm your co-host this morning alongside Paul Miller. Paul is our Senior Executive Officer of the firm. He also heads up our Middle Eastern business and sits right here in the DIFC. So my objective this morning is to take you on a journey through time, all leading us up to the initiative to link 4 billion people across 65 countries with over $2 trillion of investments. Investments designed to modernize motorways, to build high-speed rails, and of course, to promote energy connectivity. This morning, we investigate the largest infrastructure project of modern times. Today, we travel together along the new Silk Road. Now, it would be tempting to focus today's talk on perhaps how China is revolutionizing financial markets, or perhaps more easily to focus today's talk on making the bull case for investments in global infrastructure. But if I wanted to give you a good story, I would have hired a motivational speaker, because today is rather about the facts. I'll present to you what I believe to be the real rationale behind the initiative, the risks, the dangers, because the reality is I'd like to talk to you about what's at stake, because this will impact the lives of every single person in this room in the coming years. So let's begin our journey and turn back time. But the question is, where do we begin the narrative? I tell you, we won't start. We won't start during the 70s when China was industrializing, nor will we start in the late 40s when Chairman Mao assumed power. We won't even start during the period of the great dynasties, but rather in the 4th century BC. At the time when Sparta was the most powerful city-state, when the Spartans were the undeniable hegemons of the region. Now, at the time, peace reigned between Sparta and Athens, but the tides were shifting, the winds were turning, as Athens grew its navy, its wealth, and its influence in the region. Now, this reminds me of what Thucydides, the great Greek councilman, once wrote. he said that it wasn't Athens' rise to power, but rather the fear that instilled in Sparta, which made war inevitable. So this brings me to the point about Graham Allison. Right? Graham Allison coined the term Thucydides' trap, and it references this exact situation where a second world power overtakes a first, and it results in a hard conflict. Now, he does this in his expertly written book, Destined for War, within which he and his Harvard colleagues investigate 500 years of history to survey all the scenarios where the second world power overtakes the first. And I'm sorry to say that there's bad news. Of the 16 cases, 12 of them resulted in a hard conflict. But there's a little bit of good news, in that of the 4 that didn't, 3 of them were recent. Now, this begs the question whether today is not more dangerous than it was back then, with the US and China operating under the specter of a trade war, but perhaps more dangerously, an argument between 2 fiercely held ideologies. On one side, capitalism and democracy, and on the other, a command and control economy. Can China and the US put their differences aside and continue to grow harmoniously? We shall see. So let's leave Greece behind, and let's fast forward to the period of the great dynasties. And at the time, China maintained a monopoly on the production of silk. In fact, they kept its production technique a secret for many years. Silk was loaded onto caravans and traveled west from trading post to trading post, and was exchanged for articles like cotton, wool, ivory, and gold. But it actually wasn't only silk which was traded. China was also exporting articles like tea, porcelain, sugar, and spices, perhaps in the world's first form of globalization. Appreciate that's a bit of a dirty word now. But it was actually a myth. I would caution all of us not to be overly seduced by ancient maps and exotic wares. The Silk Road wasn't about silk. It was about the exchange of knowledge. It was about the trading of commodities and the sharing of technologies. In fact, the term the Silk Road was only coined as late as 1877 by a German aristocrat. Now, maybe we should linger on the 1800s just for 1 second. If you ask the average participant in the road, which countries dominated global GDP during the 1800s? And most individuals might fancy a guess of, England or France or Germany. Trump's supporters would say US. But actually, that too is a myth. It was China. And that was a title which China held for many years, but which abruptly was taken from it with the onslaught of the first of 2 Opium Wars in 1839, ushering in a period of over 100 years of civil unrest and oppression, otherwise referred to as the Century of Humiliation. During this period in 1911, the Qin dynasty finally fell. And that brought to a close 2,000 years of imperial rule. But it did pave the way forward for a change in philosophy of the government. And by the late 40s, Chairman Mao had assumed power. And he led an initiative entitled The Great Leap Forward, but which sadly failed and resulted in the death and the starvation of millions of Chinese, otherwise referred to as the Great Famine. But this did open the door for a difficult transformation from an agricultural to a manufacturing economy. And under the leadership of Deng Xiaoping, by the late 70s, China opened its doors to global markets. The program that he launched was entitled The 4 Modernizations. And what was clear is that China modernized materially. The numbers are actually staggering. For 30 years, China exhibited 10% annual growth year on year. What was clear to the world markets is that the Chinese dragon had reawoken. So we're going to fast forward, and our host referenced it just minutes ago, to the year 2013. In a barely publicized address, President Xi stands before his audience and announces what's going to be his signature strategy, a One Belt, One Road initiative. And he calls on over 60 countries to join him in what he referred to as a win-win strategy. The reality was very different. The One Belt, One Road initiative already existed. It was already under construction. And this was but a rebranding exercise designed to give direction to his fleets of state-owned enterprises and give hope to his population of 1.4 billion citizens. So it begs the question, didn't it seem a bit risky to pin one's hope on such a large infrastructure project? Or maybe he had no choice. And this brings us today to the heart of today's talk, where we ask, what was the true motivation behind the initiative to build and design the largest infrastructure project of modern times? Well, the reality is I don't need to tell you, because you already know the answer, because it remains the same throughout history. All economically and politically ambitious nations, since the beginning of time, share three core aspirations: more money, bigger guns, and of course, the desire to satisfy the ego. Understand these three factors, and you'll know where the $2 trillion will flow. Let's start with each in turn, right? And we'll start with money, or perhaps more elegantly referred to as the desire to grow economically. So China needs to grow in order to secure its future. And the fastest way for them to do that is to export more goods. But there's a challenge. And the challenge is that manufacturing centers are moving out of China into lower cost regions such as Vietnam. So their strategy is going to be to move up the value chain and to sell higher margin goods to the world's largest marketplace. What's that? Well, of course, it's Europe. In exchange, the Chinese will buy more products such as luxury goods to meet the insatiable demands of their burgeoning middle class. Let's stay on money for 1 second. The famous American artist Andy Warhol once said, "If I want more money, I just go to my bank." And that's exactly what China has done. In the 1980s, it was the Japanese who owned the largest and most powerful banks. In the 1990s, it was the Americans. And today, it's the Chinese. 4 of the 5 largest banks today are Chinese. Let's put that into perspective. The Chinese banking system commands a whopping $15 trillion in cash. What's one of the largest asset classes in the world? Well, the US housing market. That's worth about $32 trillion. There's enough cash in the Chinese banking system to buy 1 in every second house in America. One of the key objectives of the One Belt, One Road initiative is to ensure that there's continual deal flow to guarantee the Chinese banks stay in their top slot. Let's move on to the second pillar. And we ask the question, what does a gun actually get you? And the answer is security. And actually, China wants as much as it can get. It's difficult for us sitting in Dubai to visualize the wealth divide which exists between the rich eastern coastal cities and the western province. It's staggering, so much so that the government initiated a strategy entitled the Go West vision back in 2000 to help bridge this divide. And what's happened over the preceding 16 years is they invested $914 billion in over 300 projects. The problem is that the divide has only gotten larger. So, in some private conversations I had whilst preparing our flagship research report, I spoke to think tanks and analysts and political strategists, and many of them didn't write what they told me in private. And in private, many of them articulated that they believed the true rationale behind the project was all about guaranteeing security. So I was a bit skeptical. In fact, that's my job as a CIO, is to be professionally skeptical. So I just looked at the numbers, and the numbers are staggering. In 2017, China spent about $196 billion on internal security and only spent $164 billion on external military affairs. Normally, it's the other way around. You spend more money protecting yourself against outsiders than you do against yourself. So let's put that number into perspective for 1 second. China's spending about 6% of their GDP on security, and the European Union is spending less than 1%. It's actually 0.9% to be precise. Let's move on to the third pillar. And we asked for today's talk whether it's possible to substitute the term nationalism for the desire to satisfy an ego. And for today's talk, we'll look no further than the then leader's personal diaries of Chiang Kai-shek, who started every entry with 2 words: avenge humiliation, in reference to those 100 years of civil unrest and oppression. Staying on nationalism for a second, what's one of the best ways to promote nationalism? Well, of course, through the exhibition of military might. And that's exactly what President Xi has done relative to his predecessors. He's been more interested in military expansion than any of them before him. Staying on President Xi just for 1 second, it's interesting to observe that once he was re-elected for a second 5-year term, his Congress abolished limits to the presidency, thereby paving the way forward for potentially a life term in office. Right. So seen on this backdrop, you could make the case that actually the Silk Road makes a lot of sense politically and philosophically for the Chinese. But we're investors, and we need to ask ourselves, does it make sense from an economic perspective? And in order for us to do this, we just need to look at the track record. As it relates to projects tying China to Europe, we'd actually venture to say the track record is pretty good. 2 examples which come to mind are the Duis port in Germany and the Piraeus port in Greece. Does it make sense to finance the redevelopment of a deepwater port in the Mediterranean with train links into the center of Europe? Probably. What about subsidizing trains that go into a high-tech, world-class logistics hub in Germany with arteries to the rest of Europe? Probably. But the critics will come out and say, but the trains go into Germany full and go back half empty. And my rebut to that is, fine, fair point, but it took 17 years for the Eurotunnel to become operationally profitable. And now today, 80% of traffic between Paris and London pass through those means. What about some of the other examples that come to mind? Sri Lanka, Maldives, and of course the poster child, which is Pakistan. At one stage, the Sri Lankan government was spending 95% of their tax receipts just paying coupons on debt associated with the construction of one port in the north part of the island. Doesn't feel too sensible to me. It's rumored but unconfirmed that the Maldives received a one-line invoice for $1.5 billion in relation to services rendered regarding some construction. Imagine the face of the guy opening that invoice. Must have thought that like the decimal point was in the wrong place. And of course, the poster child is Pakistan. One of the key initiatives is to build a motorway through the northern part of the country. I doubt many of you have actually visited the northern part of Pakistan. Why is that? Because it's one of the most rugged regions in the world. It's a region that's prone to avalanche, landslide, and flooding, and most of it is at the same height as the Mont Blanc in France, about 15,000 feet. China wants to build a motorway through that area. I would reckon to suggest that project would be destined to fail. And in fact, I'll let you be the judge. Tonight when you go home, go onto YouTube and just type in most dangerous motorway in the world, and you can watch all the videos yourself. And you can judge for yourself whether you think that project will work, yes or no. So what's interesting is that many countries were very keen to join the BRI at the beginning, but the tides are changing and the winds are shifting. One example of that is Malaysia. Malaysia was very much on board, but now have stopped some of their high-speed rail projects. There's increased skepticism as to whether it makes sense for certain countries to take out the debt which is associated with building these projects. So this begs the question, what can the Chinese do to better the odds, to turn the tables, because there's skepticism growing? And in our flagship research report on the new Silk Road, which we've brought hard copies for every guest today, so we would invite you to take it home with you. We present a few policy recommendations. And you might say, what's a private bank giving policy recommendations. I'll just summarize them very quickly for you now, and then we'll move to close. So if the Chinese government wants to make the BRI work, what can they do today? Well, for one, they can ensure there's an economic logic between every single project. Two, they can ensure that there's feasibility studies which have been conducted. They can ensure that local laborers are employed, that they're given technical training, that tourism is promoted. They can ensure that there's a transparent bidding process. They could downplay the involvement of state-owned enterprises. They could better diversify amongst debt and equity, even offer some grants. But most importantly, or maybe most obviously, they can ensure that the trains don't go back half empty. We should draw to a close. China is rebuilding the new Silk Roads to its image. It's bringing hundreds of millions of people out of poverty. It's delivering desperately needed infrastructure to frontier nations. It's slashing trade barriers, contrarian to what the Trump administration is proposing. It's even going into cyberspace with the launch of a digital Silk Road. But as I mentioned earlier, there's skepticism. The winds are changing and the tides are turning. And if China doesn't reverse course in terms of their policies, they're going to risk a clash of philosophies and potentially, at its worst, a debt crisis which could rival the subprime. Our view is that President Xi has the opportunity of a lifetime to become the most powerful, most influential leader of the 21st century, to take back the top GDP spot, but most importantly, to avoid the mistakes which Sparta and Athens made centuries ago. But he's going to have to suppress the temptation to avenge humiliation. He's going to have to make a choice, ignore or change, because armed with the right decision, he'll be able to sidestep Thucydides' trap and put China back in its position as the undeniable hegemon of Asia. Ladies and gentlemen, thank you very much. We're delighted to open it up. Hear some of your opinions, your comments, or equally, we could move to the networking coffee session.
The Chinese banking system are becoming much more careful in credit. Gone are the days of easy credit for the Chinese state-owned enterprises to finance these projects. So with that in mind, I mean, how is China going to finance the very ambitious BRI projects across sort of the Middle East, Africa, Asia?
You teed me up perfectly, thank you. One of the investments we made was into Chinese domestic A shares Q4 of last year. And we did that for a very specific reason. China domestic shares were the most out of favor market in the world, equity market. And we did that because what was clear was the Chinese government was starting to ease across monetary and fiscal policy. Now that is the magical formula. If you want to make money and you can front run a monetary authority and a fiscal policy, chances are you will do well. And that's exactly what's happened, right? The Chinese government has lowered taxes, okay? They've increased issuance of infrastructure bonds. And perhaps most importantly, they've lowered the RRR. So essentially, they're providing a lower interest rate policy by freeing up excess capital. So whether that manifests itself directly in direct loans to the state-owned enterprises or not, there's lots of different ways that the government can go about finding finance. And they're doing everything they can to ensure that the moderating of growth from 8% down to 7 to 6 down to 5 is done in a controlled fashion. Hence the reason we've actually made equity investments in China, which, happily to say, is actually one of the best performing equity markets in 2019. Thank you for your question. But on behalf of all of us at Arbuthnot Latham, Paul Miller, myself, and the rest of the team, thank you so much for your attendance this morning. We're very grateful. Good day to you all.